very good hold on financial products, whether you call it insurance, you call it ULIP plans, you call it mutual fund, crypto, anything you ask him, it's all here in his mind. And and very humble, very grounded person, and a very beautiful friend. So, Sachin has been rocking always, and he's just a call away, if you need anything, and very intellectual. So here the stage is for you, Sachin. Thank you so much for joining us.
Wow, Nidhi, thank you for that really generous introduction. And let me start by sharing a little bit about myself. Like Nidhi said, I actually started my career with ICICI Prudential. It's I tell people that if you start your career in sales, you should start it with insurance. And if you start with life insurance, you can go on to even sell elephants and train carriages to people, because nobody wants to buy life insurance. So that's how both actually Nidhi and I started our careers with life insurance. And it was a great, I would say it was a great grounding into what has been a extremely fulfilling and enriching experience with both ICICI and Standard Chartered Bank over the last 17 years. I am a product expert. I design and manage products that everybody on this Zoom call would be using, such as savings accounts, deposit products, insurance, and also credit cards, personal loans. So these are the common financial products that make a very big difference in all of our lives. And we are not always very well equipped to understand and take the right decisions in terms of our personal finances. While personal finances is a really big topic, and we can go on and have several of these conversations about personal finance. Today, I would like to touch upon some key financial products that all of us use. I will talk about some of the common myths associated with it, and also talk about what is good and what is bad, what to watch out for in some of these financial products. Okay, so let me start by just sharing my screen. Give me a moment, please. Okay, let me know if you can see it, and let me know if you can see it in full screen. Okay. All right. So what I decided to do was a session on knowing your financial products. Okay. And let me start with a quote. This is a quote from Robert Kiyosaki, who is one of the very well-known authors on personal finance. His book, Rich Dad, Poor Dad, has been a bestseller for many, many years. And he says, financial freedom is available to those who learn about it and work for it. So you do need to spend some time on planning your personal finances. It's not just going to happen, by itself. Let me talk about another quote from another very famous person, Warren Buffett. And this is for those of you who really want to make some good money. Rule number 1 is never lose money. Rule number 2, never forget rule number 1. Pretty simple and straightforward, but very difficult to implement. And before we move on, here is a quote from me. I am not a financial advisor. What you see is only educational today. I'm sure the Brainciti team will have lots of exciting courses and learning material in the future where you can dig deeper into how to manage your personal finances best. So what are we going to talk about today? I am going to cover 3 things. However, like Nidhi said, I do have experience across a multitude of retail financial products. So if there's anything specific that you guys have in mind and I haven't covered it, I would be happy to take some questions in the question answer sessions. Right. First things first. All of us have bank accounts. All of us are trying to save. All of us are trying to invest. But what are some of the very fundamental things that we really need to know? Right. The first money myths that I want to talk about is a lot of us feel that if we just set aside some money every month in our savings account, um, whatever that figure is, 20% of my income, 25% of my income, 10% of my income, 5% of my income, somehow we feel that when we retire, we will have a large enough corpus um, to take care of our happy retirement life. Sorry to bust the bubble, but the answer is no. And the simple reason for that is this problem: inflation. Inflation is constantly eating away on your savings, especially if those savings are in a simple savings account where you're getting, let's say, depending on which market you are in, either 2% interest, 4% interest, 3% interest. Uh, in case of India, I believe the current inflation rate is somewhere between 5.5 to 6%. So you would know, with simple mathematics, that your savings are actually getting devalued every year. And definitely it's not going to be enough by the time you are ready for your retirement life. So what are the things that are available to people like you and me to invest in and make sure that our money works harder than just the savings deposits? Okay. Not to say that there is anything wrong with a savings account or a time deposit, but the fact is that we really do need to diversify our savings and investments. And thankfully, there are quite a few options available to people like us. So here is a very simple metric which says on the y-axis you have risk, which means that if you put your money in a deposit, it's really safe. It's quite safe. But on the x-axis, you have returns or profits. So if you see, deposits are very safe, but will give you very, very little profits or returns. On the extreme side, you have highly risky products like derivatives. These will be in stock market, you would have heard about things like call options, future contracts, etc. Difficult to understand, difficult to master, but of course, if you have the right risk appetite, you can make a lot of money. So what should be a common person's strategy uh, in terms of choosing these investment products? I'm going to talk about two things today. One is deposits and one is mutual funds. These are easily accessible, available to all of us. We can either go to our bank for these products, or we can go to our brokers. There are a multitude of now digital financial applications where mutual funds are also accessible. So I'm going to talk about these two today. But the most important thing is that all of us need to look at a portfolio of investments. If all your money is sitting in a savings account or even a time deposit for that matter, it's really not going to work in the long term for you. Here is a simple number. If you had invested 10,000 rupees, let's say in December 2006, and you had gone to your bank and you had gotten a pretty good fixed deposit rate of 7%. In about 15 years' time, which is early this year, you would have received 25,000 rupees after that very long wait. If you had taken the exact same amount in the same duration and put it into a mutual fund which was simply tracking the BSE index, you would have gotten back some 36,500 rupees, which means that there is a 40% difference in what you could have made from your bank account versus what you could have made from this mutual fund. Now, I'm not saying that everybody should go ahead and put all your money in mutual funds. Absolutely not. But it is important to recognize that they are options which you need to consider in the long term, which become quite safe. So if you take essentially any period of a 15-year cycle, your risk on a BSE Sensex linked investment would come down, and your returns would definitely be better than what you would have received from a savings deposit or a time deposit. So this is something that you really have to keep in mind. Okay, so that brings me to what are the things that you must know about your bank accounts. Okay, the first thing is, of course, you earn interest, and let me dwell on this a little bit, because most of you who have bank accounts which are really old, let's say you opened an account when you started working, which was 10 years back, 15 years back, 20 years back, chances are the interest rate that you're getting in that particular bank account is really poor as compared to some of the new savings offerings in the market. So the first thing probably you should do is go and look around and see what other banks are offering. While you might have this emotional connection to your old bank and you know the people there, at the end of it, you're a customer. And mostly the new accounts in the market or the new banks, for that matter, in the market are more hungry for deposits, and therefore they are ready to give you better interest rate. So look around. Your capital is, of course, guaranteed, but it is not always the case. As we know, there are rare cases of bank failures, and in that case, the government will usually have an insurance on your deposit only up to a certain amount. Whether it is, I believe it's around 4 lakh rupees in India, which is not much. But it is still quite safe. So those are the good things. Of course, it's easy to access your funds. And your fees and charges are typically quite low. And that's the reason why most people end up saving a lot in a savings bank account, because it's so easy to operate. But remember what's not so great. The interest rate in probably the safest other asset class, which is, let's say, corporate bonds or even government issued bonds, is going to be higher. So while you take up a little bit more risk, you can get a disproportionately better interest, especially if you consider the long term. You can get better interest from bank accounts, but you will have to open a time deposit, which means that then you will have to lock in your funds. Unlike a mutual fund where you can actually, most of them, you can access your money anytime. And while bank accounts have low fee, it does not mean no fee. So banks do earn a substantial amount of their income from the fees that they levy on your accounts. So every time, for example, your balance falls below a certain amount, they will charge you a fee. In many transactions, especially high ticket transactions, there will be fees. If you have a debit card issued against your bank account, there'll be fees. And in case of time deposits, of course, if you don't wait till the maturity, there will be fees. So watch out for these fees, and especially when you are taking your next bank account, keep this in mind. Okay. Let me move to the next. The second thing I wanted to talk about was mutual funds. Now, I might sound like a mutual fund salesman, but the fact is that in all my experience of financial services, for the retail investors, there is hardly a better investment instrument. The first thing is that there are hundreds of funds to choose from very low risk funds such as money market or debt instruments to very high risk funds where you have, let's say, equities of a very specific sector. The good thing about mutual funds is you can really diversify your risk. So again, depending on your risk appetite, you can have access to funds and investments across geographies, across sectors. You can have mixed allocation funds, and the long-term investor will find it really easy to get risk exposure with this instrument. Okay. The easiest way is to set aside some money and invest on a monthly basis. This also works on a concept of dollar cost averaging, which means you really don't care whether the market is moving up or down. Over a long period of time, when it is down, you'll get more NAVs of the fund, and when it is up, you get slightly less, but you will average it out over the long term. So the systematic investment plan is really good, and mutual funds backing it is a really good, solid long-term way to invest. Most of them are also very liquid. So if you want to withdraw your funds from a mutual fund, it typically takes 2 or 3 days, and the money is back in your bank account. So in case you really need the money, you need the cash, you have a big event coming up in your life, you have your child who has now grown up and is going to college, you have access to your funds. And also importantly, they are fairly reasonable in terms of fees and charges. What of course is not that great is your capital is not guaranteed. So if you don't have the risk appetite of seeing even one day that the market has gone down and your 100 rupees has now become 95 rupees, this is probably not the product for you. But like I said, over the long term, it really doesn't matter because irrespective of the asset class that you see that the typical mutual fund invests in, you would be making good money over the long term. Sorry.
Sachin, can I ask you one question here? So, how can we, assess the risk appetite here? Like in case if we want to do that, because mutual fund is between equity and, it's between equity and your mutual funds.
Yeah, Nidhi, that's a very good question. And the simple answer is that everyone's risk appetite is different. And which means that no one will be able to advise that this is your risk appetite. You are a high risk customer and you are ready to take more risks. And I'm a low risk customer. I'm ready to do more, less risk. There are a host of tools available online. If you just Google assess my personal risk appetite, and I can share some links with the community after this call. You have to go through a process, which is typically a question answer process, which comes up with a prediction or an assessment of how much risk you can take. And the more risk you can take, the more long-term products that you should invest. But this is very, very important. It's almost like your blood group. You should know, your blood group, and you should know what your risk appetite is. Because if you don't know that, you can't make the right investment decisions.
So should I go for mutual fund or equity? What do you suggest?
So you should first do your risk appetite assessment, and only then we can advise you. You should go. I mean, I would always recommend a good mutual fund. But what type of mutual fund can be assessed only after you have gone through that process of self-evaluation. and understanding how much risk you are happy to take, right? What you have to remember about mutual funds, they are not free. Of course, all of these products have charges. Typically, if you buy it from a mutual fund broker, they will charge you anywhere between 1 to 5%. The interesting thing is, inside a story, most of them will negotiate. So if you are making a decent amount of investment, you can really get the sales price down. And of course, if you have a long-term relationship with a mutual fund broker, then again, they should be giving you a better deal. So don't take it on face value. There is
That
always
means
a fund.
100.
Sorry, go ahead.
That means 100 rupees is there. So 1 to 5, I can negotiate on his brokerage, and then I can invest that.
Exactly. So typically, what will happen is, if you are investing 100 rupees, they will say only 97 will actually go into the investment because 3% is my commission. But then, like I said, depending on what is the amount you're investing, what is the relationship, whether it is a bank or a broker, these are usually negotiable. So you should try to get the best deal out of it. There is always an annual fund management fee as well for mutual funds. This is typically not negotiable. Um, and the interesting thing is that this is not even visible to you, but there is always a fee. So it might not be a bad idea to ask your broker what this annual fund management fee is. There are some funds which will charge you a fee if you withdraw before a certain time. Again, a good question to ask your mutual fund broker or a relationship manager in the bank, whether this is a closed-ended fund or it's an open-ended fund. Okay, so a few things to help you make your next mutual fund conversation a little easier. But some actions that we need to take away. First thing is that you have to have a monthly plan or a budget of how much you will invest. Now, where all will you invest is, like I said, is a risk appetite assessment. So you have to complete a personal risk assessment. And last but not the least, let me reiterate, having all your money in cash in a bank account is not great investment planning for the future. And you have to diversify your investments. So these are the few takeaways on your investment strategy. Let me come to money myths 2 now. So remember, I was going to talk about 3 things. One was investments. Second was, it could have been loans, but loans is a really big topic. So I picked the most common instrument that a lot of us use, which is credit cards. And there's one very big myth with credit cards is, a lot of people feel if they keep on paying a minimum due every month, it's okay. Actually, it's not okay at all. So while you can escape fees and things like late fees and other charges if you pay a monthly minimum due, you will not be able to escape the interest that gets levied on your credit cards. And just to give you a sense of how much interest can this be, let's say you have a credit card balance of $10,000. This can be rupees, this can be anything. Typically, a credit card interest rate is around 3% per month, which translates to a whopping 36% interest rate per annum. And let's say you decide to pay only 500 monthly minimum due on this balance. One, you will end up paying this 10,000 rupees or dollar loan in the next 31 months. And number two, you would have actually paid 5,400 and almost $5,500 as interest, because over time, that's how your loan will get repaid. So it's actually not okay. to be in that zone where you are only paying the minimum due. Yes, once in a while, it's absolutely fine. You need your cash for something else. And 1 month you decide to pay either not in full or only partially. That's okay. But remember that credit cards actually charge a pretty high interest rate. Okay. Having said that, credit cards are very good if you pay on time every time. Mm, most of your cards will either give you cash back on what you spend, will give you lots of exciting reward points. And I know in actually places like Dubai, you have popular air miles like Emirates or even the other airlines of the Gulf, which can be really valuable. So credit cards are actually great products to, how should I say, monetize your spend. If you are going to spend 10,000 rupees and get nothing for it, might as well use a credit card to spend it and get a cashback or a reward point or air miles out of it. Okay. You do end up paying annual fees for your credit card unless you're a very hard negotiator. Again, insider tips. Most of the banks will let you negotiate the annual fee payment, especially if you're a good customer and you have been using the card a lot. So it's not about always paying on time. If you pay on time, actually the bank doesn't make any money. But if you spend a lot on your card, then you earn rewards or cash back, and the bank also gets paid through something that we call interchange, which is essentially the merchant where you've gone and done the spend actually pays the bank because the bank's card has been used. So everybody is happy if you spend a lot, and you can actually negotiate your annual fee as well. If you continue to pay in full and before your due date, uh, very importantly, there is a credit score which is getting calculated for any of us who is using a loan product. And if you have good repayment behavior on your credit card, that reflects very well on your credit score. And that means that next time when you go and take a personal loan, or if you need an auto loan, or if you need a if you need a if you need a mortgage loan, a home loan, it's much easier for you to get a loan than someone else who has been repeatedly defaulting on their credit card. So paying in full on time is really good. But if you don't do that, um, you keep on spending on your card, but not pay on time, or pay only in part, or pay late, which is the worst, you will still earn your rewards and cash back. You will not be able to negotiate your annual fee, very unlikely. You will pay a very heavy interest rate, which are called finance charges, which I just showed you a simulation of. In case you're late, you might end up paying late fees, even things like over limit fees. And finally, you might even find it difficult to get a personal loan or a home loan in the future. So, it's credit cards, I say, is not for everyone. If you're disciplined, then it's a good product. If you're indisciplined with your finances, it's a bit of a tough one. So,
do we have some, like, nowadays we have some common list of defaulters? So credit card hits that credit score, right? Like people
absolutely,
say.
yes. So, Nidhi, this is a very important piece to understand. Most markets, most countries now have a concept of this list of defaulters, which you just mentioned. It's called the credit bureau. And every bank which issues a credit card is obligated by the regulator to report the performance of each customer, how he or she has been using their card, to this bureau. And every time the same customer goes to any other bank to ask for a loan, the bank will go and check this customer's bureau records. And many a times, we have customers calling in and telling us that because of you, I am not getting my home loan. And it is actually not because of us. It is because the customer had been missing their credit card bill payments, despite the bank repeatedly reminding them to pay.
Right.
What they're not realizing is that what they feel is a short-term issue of, okay, I will pay later, can have a very long-term impact in your personal finances. So this is something that all of us should keep in mind.
Thank you so much.
Right. Let me come to the final product that I wanted to cover, which is something close to my heart and Nidhi's heart as well, because we started with life insurance and insurance in general. Um, I in the last 17, 18 years of my financial services career, I personally haven't met anyone who can confidently say that I have sufficient insurance coverage. In fact, most people run far away from insurance. And if they do have insurance, it is severely insufficient. And we're going to talk about that now. So again, if I sit down with you today and spend half an hour discussing your insurance coverage, I can assure you that you will find gaping holes, um, and you will be a bit worried that you did not think about it earlier on what kind of insurance you should have had. The problem with insurance is it's a pretty complex subject. First of all, there are so many different types of insurance. There is life insurance, there is health insurance, home insurance, travel insurance, accident coverage. If you buy a motorcycle or a car, there's auto insurance. So it's a pretty vast topic. But typically, we divide insurance into life and non-life, or life and general insurance. So everything that protects the financial future of your family, in case something happens to you, to me, my family is protected, is really life insurance, and everything else is typically general insurance. To dig a little deeper in it, like I said, even life insurance can have multiple types of policies, and it's actually it can get very confusing uh, to the common person, right? Because there are just so many different types to choose from. Here is a very simple chart. One is pure insurance, which means there is no investment linked to it, there is no savings plan linked to it. This life insurance gets paid out to my family in case I pass away within the coverage tenure of the insurance plan. When the coverage ends, nobody gets anything. So even if I'm alive, I don't get anything. And this by far is the most important life insurance cover, which is not going to be sold to you. And there are some very good reasons for it. On the other side, you have insurance and investment policies, which a lot of people will talk to you about. These can be whole life plans. So I keep on savings for all my life. I get a big payout at the end of it, at the end of the term. These can be unit-linked insurance policies, which have a mutual fund type of an instrument at the back of it. These can be money-back policies. If something happens to me, my family gets a payout. If I survive the insurance period, then I get all my premiums back. And very popular endowment plans, which are um, the typical savings plan, which your insurance agent will talk about, is endowment plans. Now, I'm not saying insurance as an investment is um, is something very, really bad, but not at the cost of taking a pure life cover. You have to really sit back and take and think about taking insurance for the most important purpose. If something happens to me today, I want my family to get a really large payout so that they are not in financial trouble. And the best deal that you will get on it is from the term insurance plans. General insurance, again, so many different general insurance to talk about. But I think the most important one that uh, we need to consider from a personal finance point of view is health insurance. Again, some common myths about health insurance. I work in a company, my company fully covers me. I hear that all the time. The day you leave the company will stop covering you. Also, remember that when you have your own personal health insurance, and if you have it early enough, that covers all your pre-existing conditions for a very long term. So, not having a personal health insurance cover is a really big gap. And again, health insurance itself comes in many shapes and forms. The most common one is hospitalization cover, which is an absolute must. So all of us need to go back and look at what we are covered for, how much we are covered for, what is the sum insured, and really do a reality check that in today's hospitalization prices, is that adequate? Is it the right coverage that I have? Um, and if not, you need to do something about it. So, few things about life insurance. What is good? It really protects your family. I mean, we have all seen, unfortunately, what is happening over the last 2 years in this terrible pandemic. And while there is this massive emotional, burden of dealing with a loved one passing away, what comes after that for the family is a financial burden. So it's extremely important to not make your family go through that and have a proper life insurance cover. What is really good about life insurance cover is if you have a if you have a good policy, then you can add riders to enhance your policy with a very little premium. And this can cover things like if I have an accident, I become disabled, if I get a critical illness, all of these can be covered with uh, a little more premium. And remember, I said health insurance. Health insurance has to be taken at a personal level, other than what you have from your company, which is really good. Because, like I said, when you become old, when you're no more working, your company is not there to cover you. And that's the time when you will really need the medical coverage. So, so think about it. Um, most of I've seen most of my previous generation, my parents, my father-in-law, my mother-in-law, taking grossly inadequate health insurance coverage. And what that means is that if somebody falls really sick or ill, the burden will again come down to your family. So either you are really taking away your investment pot, or you are basically dependent on your son or your daughter to fund for your health, which is obviously not a great place to be in. What to watch out for? Insurance is a push product. It is not something that you and I wake up in the morning and say, "Hey, today I want to buy an insurance policy." Nobody does that. Yeah, you might want to buy a car accident insurance policy because you are buying a car, but nobody wakes up on a Saturday morning and says, today I'll buy life insurance. Simply doesn't happen. Somebody comes and sells it to us. And the next time somebody is trying to sell this to you, keep a few of these things in mind. What is the pure term insurance cover you have? Whether your health insurance is sufficiently adequate or not. After you have covered these 2 points, then talk about things like, insurance as an investment product. Like I said, it's not a bad form, but it's definitely not the best form of investment. We spoke about investments earlier. Money in a term deposit will give you a better interest rate. In a mutual fund will get you a much better return than an insurance product over the long term. There are many exclusions when you're buying an insurance policy. Insist on knowing at least all the key exclusions. One more thing which I haven't put here, but is a very important thing to consider is, yes, premium is important and cheap premium is important. But a very good question to ask your insurance agent is, what is the payout percentage of your insurance company? Which means that out of the claims which come to them, how much are actually paid out? Which is really why you're buying insurance. Because if you pay a low premium and the company comes around and says, points at terms and conditions when you actually need the amount to be paid out to you, it's no good. So it's a good question to ask. There are some charges in insurance which are always non-transparent. Most of the time, they will remain non-transparent. But all I can tell you that they are charges. They are heavy charges. Of course, depending on what type of insurance policy that you're taking. But remember again that because of these reasons, insurance as an investment plan is not able to compete very well with pure investments such as mutual funds, buying bonds or buying equities of companies. So finally, some actions to take away. Number one, I will review my insurance coverage. In the peak of the pandemic last year, I sat down to review my own insurance coverage. And despite all the knowledge and experience I have, I was surprised about some key gaps that I found in my own insurance coverage, which I've been able to fill, of course, in the last few months. But as a thumb rule, 10 times of your annual income should be the life insurance cover that you have. This is a thumb rule. If you can get more, even better. But you can do that quick calculation right now while listening to me, and you will realize that most of you will be short of this number. Every time you have a life event, like if you've gotten married or you have a child, of course, you should sit down and review your insurance coverage again. Because if you're single, what liabilities do you have? You don't have a family, to take care of. But now, if you have a little child and you have a spouse, things have changed. So you need to change your insurance cover as well. And I've been reiterating this. Do not depend only on your company for your hospitalization coverage. I've seen many good friends get trapped by this. In between jobs, they've had to have some kind of a surgical procedure, and then it's been a disaster on their finances. So watch out for hospitalization cover.
Sachin, should we take insurance as a saving plan, or it should be only for the coverage?
Yeah, so Nidhi, like I said, before taking it as a savings plan, I will not say that you should not take it as a savings plan. But before taking it as a savings plan, you have to take a pure life cover. That is extremely important. if you talk to your parents, what they have been sold for the last 50 years in India is endowment plans, which means that every year the insurance company or the insurance agent or whoever, the bank, will tell them, why don't you take this new insurance policy, which is all good. But if you add up the coverage in all of those insurance policies, because it's a savings plan, the coverage is lower. So you need to ensure that your sum assured is at least 10 times of your annual income. And if you try to take it with a savings linked insurance plan, the premiums will be very, very high. That's why you need to take a pure term cover to first take care of the most important thing, which is why people should take insurance, is to protect their family. After that, if you want to take it as a savings plan, investment plan, feel free to do it.
So in case if I have 100 rupees, what do you think how I should divide that? If I have to save 100, suppose 100% is my saving, how should I divide in different baskets to divide my risk?
Yeah, so again, we are going back to the question of the risk appetite, right? Uh, some of my friends have put all 100 rupees in cryptocurrencies. I know they are the hot topic nowadays. But again, their risk appetite is really, really, very high. Typically, you should diversify. A classic investment would be, um, you know, an insurance. I'm keeping it aside. I'm not considering it as an investment option. You should probably have enough savings to last you 6 months. Even if I'm out of a job, my savings should at least cover all my expenses for the next 6 to 12 months. That's the amount of cash that I should maintain in my bank account or in my term deposit. The remaining 80% should be invested depending on what my risk appetite is, whether it is mutual funds, whether it is equities, whether it is gold, whether it is real estate. We didn't talk about that today. Um, so I follow the 80-20 rule, 80% invested and 20% in cash. But like I said, everybody is different and you need to do your risk assessment. All I can say is 100% in cash is not a great investment strategy at all, because we talked about it, inflation is going to eat up all your cash.
Perfect. So we have one question from Ashish Gupta. Ashish, are you here? Ashish? Okay, his hands were up. Okay. Which health policy is good, LIC or any other? So that's a common question which comes with LIC.
Yeah. So first of all, let me say that LIC or any of the insurance companies which are backed by the government are very good, are really very good. So your money is safe. Um, Most of them have a fairly good payout ratio as well. What you will probably not get is really good customer service. So if you can compromise with, if you're like, for example, really used to online services, you want to do everything digitally, then maybe the traditional or the government-backed insurance companies are not good. But otherwise, they are quite good. Having said that, the insurance sector is very heavily regulated. It is as heavily regulated as banks. So even if you're getting a policy from a private insurance company, you can be rest assured that it's going to be safe. They are going to meet the customer's requirements, and you you can be assured that they're not going to run away with your money or anything like that, right? Um, Obviously, the private insurance companies are trying to get customers. They are trying to be innovative. They are trying to give you more options. So no harm in comparing all the plans before you take your decision. Um,
Thank you so much. So I think Alex Thomas has one question. So please.
My sincere apologies, sir, before I ask my question. You have had this opportunity of guiding us on the various kinds of things. And I have been a victim of ULIP. I've been a victim of money back policies. And later when I realized these were really weapons of mass financial destruction, and the only policy that people should go, obviously I understand you are coming from a background of selling insurance. Do you think term insurance is good enough for people, and they should not invest in other forms of insurance, especially for the money part?
yeah, I mean,
the only reason I ask is because, everyone here is looking to you as an expert. And I know you have very clearly told, yes, the return may not be. ULIP, 12 years, 15 years gives you less than a savings bank account. Money back even destroys it further. They don't even give you your own money back. And if you look at what you mentioned is very clear. If you look at traditional insurance policies, when you do 10 years annual income, you don't have that kind of a salary if you go for a conventional one, unless you go for a term plan. So from an insurance expert or a finance expert, would you suggest that people should only go for pure term and focus on mutual funds for investment and health insurance instead of going for a reason is I'm 56. I have recreated myself as a financial evangelist between direct plans and regular plans and term insurance. And so what are your views here? Because a lot of people may not have lost as much as I have, but you have very clearly said that health insurance is important and you should have a health insurance of your own other than the company. So, I mean, I hope you can use this opportunity to clearly tell people so they don't get sidetracked.
Yeah, so Mr. Thomas, short answer is yes. Term insurance is most important, which most of us don't pay attention to. So that is the number one thing that you have to do with your insurance policy. I will not make us, I will not say that all insurance linked investments or insurance linked savings plans are wrong or bad. Sometimes it just so happens that the people who are proposing these plans to us are not completely transparent, and they are sometimes acting in their own interest in the long-term interest of their customers. But if like I said, if I had 100 rupees to invest, not 1 rupee will go into insurance as an investment.
Thank you very much.
It would rather go somewhere else.
Thank you. I really appreciate your honesty in this matter, because it makes a lot of difference for people who have not even got the basic insurance.
Yes,
Thank you.
Thank you so much. So in the chat, we have shared our link of WhatsApp group to ask more about investments, money, finance. So in case you want more insights and knowledge, you can join our WhatsApp group. And is anybody else for the question?
Yeah, good evening. Can I? This
yes,
is Radishan.
Yeah, please, sir.
Yeah, good evening, sir. I don't know whether it is the right platform to ask my questions, rather a query. Recently, the government of India, I'm just going to talk about the welfare schemes, which has some link with these mutual funds. Recently, the government of India has actually waived out to go for this. That means contributory pension schemes. The people who have already completed 50 years. So I did it that, but I have seen that the government of India has assigned certain agents kind of institutes, some record keeping organizations or institutions. I never validated it at all, or even I was not able to get it. I Googled it, I did a lot of research. So once I put a specific amount of 5,000 or minimum amount was 500, I think, or 1,000, certain amount what they do is that they further divided this amount into different mutual funds or certain schemes, tier 1, tier 2, tier 3, which is not clear to me. Am I really into the right track or a wrong track, or my money is safe or not? I don't know. What is your take on this, please?
So Mr. Rathisan, I cannot say for sure what exactly is the financial instrument that you have invested in. Typically, Government of India schemes are distributed, which means you
it
can.
is national pension scheme, sir. It is national pension scheme.
So, where have you taken it from? When did you make the investment?
Almost 1 year back.
No, where? Did you go to your bank, or did you go to the post office, or did you go to any other government office to make the investment?
Nothing. I did some research, Google research, and I seen that it is comfortable, and I tried it.
Yeah, so see, I haven't seen your document, so I can't really advise you in terms of what scheme you have gone in for. But what I would recommend you to do is read the documents that you would have received after making that investment, and ensure that it is regulated by RBI, or it is actually a paper issued by the Government of India. That is very important to do. And what my recommendation would be going forward, if you are actually looking for a scheme from the government directly, then either go to one of the government banks like State Bank, or go to the post office if that is one of the centers from where they are distributing it, and that makes it a much more safer bet, because it is from a government government bank, or like I said, a government office.
Thank you so much, Sachin.
Thank you. Thank you. Yeah, if you don't mind to share your contact number, can I have access to contact you later, if you don't mind?
I'm sharing his LinkedIn profile.
Ratishan, you can join the WhatsApp group that we have circulated. I request all of you guys to join the WhatsApp groups. Therein we will put the experts and the mentors, and then they can guide you as well. You can individually contact. So we have created the Brainciti Money and Finance group. So wherein every Monday you will have a speaker speaking about something. So you will get access to a lot of other speakers, a lot of other mentors, and you can contact Sachin as well through that. So join our, and if you have any doubts and all this thing, these experts can really help, and the Brainciti experts can really tap in and give you some personal advice and all this sort of thing. So join the WhatsApp group. Again, Prashanti has circulated it, from wherein you can have interesting conversations with people around money and finance.
Yeah, that's nice. Thank you very much.
Thank you, Ratishan. Over to you, Nidhi. I think we can conclude the session.
Yeah, Devakar has one question.
Thanks.
Yeah.
I hope we have time for just one question. So Sachin, I was just wondering, one of the things which I keep wondering is, can we take multiple insurances, as in more than one? Because I always keep worrying that maybe, one of the insurance companies will not pay up, or, they go bankrupt or something like that. So can I divide my cover across different insurance companies?
Yes, in fact, I would recommend that you do that, because diversification, whether it is investment or insurance, is always a good policy. Don't put all your money in with one bank. Don't buy all mutual funds of one type, and don't buy your insurance from one company, because like you correctly said, it's like putting all your eggs in one basket. It's a rare event that, especially in India, if an insurance company actually goes down, but it is not impossible. So it will make sense to actually spread your cover from multiple companies.
Got it. Thanks.
Sarit Sahu has one question. We'll take this as last. Sarit?
Yes, yeah, it was a good, very informative talk. I have one question, like, is it how is like HDFC Life, SBI Life, that ULIP plans? Is it better or mutual fund will be better? Like,
Yeah. So like I said, honestly, I have started my career with insurance. There is nothing wrong with ULIP plans, depending on how you configure them. So if you are trying to make your ULIP compete with a mutual fund, it will never compete. Your mutual fund will always give you a better return.
better.
But if you consider a unit link plan where you have taken a high insurance cover, which is almost like a term cover, and at the same time you feel that the returns will be better than, let's say, an endowment plan, then it's a great policy to take. So it really depends on what your objectives are.
Okay.
If you think it is better than a mutual fund, no. Short answer is no. It is not better than a mutual fund from an investment point of view. From an insurance point of view, it can be better. I mean, of course, mutual fund cannot compete with the insurance plan, right? So that's the way you have to think about it.
Okay. Thank you. Thank you so much.
So we have one question in chat. So virgin gold bonds are better. Please advise.
Sorry, Nidhi, I missed that.
The gold bonds are better. Please advise.
Bonds are better. Okay. It's the bond market is actually several times bigger than the equities market.
Sachin, so I think he meant sovereign gold bonds.
Oh, which sovereign gold bonds are better? Okay. Honestly, I can't say specifically for India now. I've been out of India for a while. But short answer would be any sovereign gold, any gold bond backed by the government is good. But having said that, remember why you are buying gold. You're buying gold because it is a hedge against something else going wrong. So let's assume a very disaster type of a scenario, which I'm confident will not happen in India, but has happened in many countries, which is, let's say, hyperinflation. Venezuela, Republic of Congo, these are countries where people have witnessed hyperinflation. What you could buy a bread for 100 rupees today, and tomorrow the same bread is costing 1,000 rupees. It's called hyperinflation. In that scenario, you need a currency which is universally accepted, like gold. So my honest recommendation would be that if you are investing in gold, try to get physical gold, or at least have a way to access the gold that you're investing in. That would be my recommendation. Otherwise, in terms of any bond which is backed by the government, by the sovereign, is safe enough. It's good.
Okay, thank you so much, Sachin, for your time and things. And as we are coming to an end, I'll introduce you to Yash. He's the co-founder of Brainciti, a very young, energetic, and full of energy person. So over to you, Yash.
Thank you, Nidhi, for hosting the session, and thank you, Sachin, for a wonderful insight for money and finance.
Yash, you got muted.
Thanks. Sorry, guys. So as a Brainciti, we are on this constant mission for over an year to bridge the gap between the coaches and the experts and to the people who require this knowledge and all this thing. So, and through this, we have started this 100 days, 100 speakers. We have already done one sync in the past that was with around 200 plus speakers. That was with empowerment talks. And this, now we thought of, okay, there is more and more requirement of the people who we can reach out to through this platform. And to be very honest, with the inculcation of the digital tools, we are very much glad that we are able to reach out to more masses of the people. And this is only possible when people like Sachin accept our request to come to our platforms and give this wonderful knowledge and share this with the people. And how you can help us is, we do it every single day, and we will be doing, tomorrow will be something else, and tomorrow will be something else. By spreading out this word of mouth and spreading out the links and the shares that we do to your friends and family and colleagues, so that more and more people can be made aware of what we talk about here. Like